The British Prime Minister Boris Johnson speaking earlier in the House of Commons, warning of a perilous turning point as he announces new restrictions due to the resurgence in COVID cases that we're seeing in the UK. He will speak at 8 p.m. as well tonight. Joining us now to assess all of this, Bilal Hafeez, Macro Hive CEO and editor. Bilal, Boris Johnson's trying to walk a line between a full lockdown and bringing people back to the office, allowing people to socialise. It is a very, very difficult needle to thread. In terms of what the implications economically of what we've seen announced today, what do you think they are?
Well, I think overall they're quite negative because, for me, it's about the trend in all of these announcements. So only a month or so ago, the government was trying to encourage people to return to work and trying to just overall, suggest that we're unlikely to get a major second wave. Now, suddenly we're in a potential second wave. We're getting these potential lockdowns for the next six months. And also with the amount of changes we're seeing week on week, the announcements we've heard today from the Prime Minister are unlikely to be the last ones. So I imagine we are likely to see further restrictions as the weeks go on. And one big and obvious one is whether schools and colleges shut down at some point. That, of course, wasn't announced today, but that would be another sort of possible restriction that we could see.
Yeah, and that's when Guy cries because the schools are shut down. So the results from analysts are starting to trickle in. Bank of America now sees no growth in the fourth quarter or for the first 3 months of 2021. What kind of estimates do you have to model?
Yeah, I think the issue with the UK is you also have Brexit as well, which complicates the picture overall. But overall, I would think that the growth rate over Q4 will be close to zero, if not lower. And then the early part of next year will also be quite negative as well. So you have this combination of increasing restrictions plus the Brexit effect. And so overall, it's going to have quite a negative effect on the UK economy. So in terms of projections, I'd be more on the lower end.
Do you think this is going to be something that we're going to see in the rest of Europe?
Well, I think it will vary country to country. The key ones, of course, for European markets is what's happened to Germany and France. And so far, at least Germany is handling the COVID crisis much better in terms of restrictions and lockdowns than other countries. So I think it won't be as extreme in, say, Germany, or not even France here, even. And if you look at the activity data in those countries, they rebounded much faster than we've seen, say, in Spain or in the UK. So I think we will start to see some kind of restrictions in some of those countries we already have, but they won't be as extreme as we're seeing in the UK. On top of that, you have to remember their fiscal support programs are much more generous and are likely to last much longer than anything we see in the UK.
I also wonder then, how do you look at what's priced in? There's a great chart on the Bloomberg terminal that took a look at the 530 curve here in the US and over in Germany on how the widening of that is the most we've seen since the first half of 2015 as the curve here just continues to steepen. What's priced in and is it correct?
Yeah, no, that's a good question around what's priced in. It depends on what information you're taking out from the curve. So I think the curve steepening, for me, represents fiscal loosening that we're seeing in many countries around the world. So that tells us that the market is pricing much worse fiscal deficits in the years to come, which I think is a fair pricing. On the other hand, if you look at the performance of, say, stock markets in, say, Europe or even in the US outside of the tech sector, stocks have generally gone sideways for the past 2-3 months in reality. So that tells you that the markets are kind of pricing a slowdown in growth, certainly, less of a V-shaped recovery. So I think that's at the moment what the market is pricing, a moderation in growth, much larger fiscal deficits, but at this stage, no recession.
Let's talk about what action we're going to see from central banks. We're going to be hearing from Jerome Powell very shortly. We'll talk about that in a little while. Today, the governor of the Bank of England pushing back maybe a little on the idea that negative interest rates are a near-term possibility in the UK. The ECB, though, looks as if it's warming up to the idea of potentially doing more QE and extending that QE into other programs. Just give me a sense of kind of whether or not we are going to see significant central bank stimulus coming from here and what implications that's going to have on pricing.
No, that's a good question. I think, ironically, the ECB is probably going to be the central bank that will deliver the most easing, or I should say the most effective easing going forward, because they have the pandemic program, the PEP program, and they are, as you say, going to expand the QE program. And so that provides a lot of support for the European economies to fund their fiscal deficits and also to fund broader programs to support their economies. I think the other central banks, like the Bank of England in the US, they're a bit more of a sort of tricky situation. I think the UK has boxed itself into this debate around negative rates or not. For me, if the UK does go down the negative rates route, that for me is a currency story insofar as it would potentially lead to a much weaker currency, which, you know, through the import-export channel could stimulate the economy, although that would be short-lived. And I think the US or the Fed is somewhat sort of, you know, has a convoluted communication strategy around its average inflation targeting program, where it's announced this big change, but then it's walking back, you know, whether it is able to generate inflation or not, which in some ways undermines this big change that they've announced.
Okay, so let's get to that big change, because we talked to the St. Louis Fed President Jim Bullard yesterday, and it was surprising because he said maybe we actually don't need stimulus. That was like the lone central bank voice out there, it feels. This is part of what he had to say.
I don't think there's as much of an imperative about a new fiscal package as there might have been, you know, in July or as it might have seemed in August. So it seems like, at least in some broad macroeconomic type of calculation, we have enough resources to cover this.
Which, you know, is a fair point. You got housing data out today. Sequentially, we're slowing, but it's still in positive territory. A lot of the Philly Richmond Fed Index, for example, really surprised to the upside. Where's the truth in that?
Well, I think that tells you that both the manufacturing sector and the housing sector are two sectors that are generally doing quite well, even though we've had this pandemic. And this would be the story not just in the US, but also elsewhere. In the UK, you've seen this week house prices rise. Construction data in Germany has been very strong. But the larger chunk of the economy is services, which remains under pressure. And now with fears of a second wave, that those sectors will come under sort of further pressure. So from a central bank perspective, there will be additional challenges for them to stimulate the service sector. So there is, I think, still a need and scope for the central bank to do something. Now, of course, the real policy that should be enacted here is likely to be fiscal policy. But the problem, of course, in the US is with a divided Congress and election coming up, then that's less likely to come forward. So the Fed would probably only be prompted into action if stock markets are correcting much more sharply lower.
Bilal, as we look to what is happening on Capitol Hill right now, you've got the Treasury Secretary, fiscal, you've got the Fed chair, monetary. If we don't see the fiscal side delivering because the Republicans decide that the filling the vacant seat on the Supreme Court is more important than stimulus, what can monetary policy do in the near term to compensate?
Well, that's a very good question because, of course, interest rates are incredibly low, and the Fed has announced its new inflation targeting program. I think there's some things they could do. You know, one is that they've already announced forward guidance for the next 3 years that they won't raise rates. But what they could do is they could start to announce some kind of yield curve control, so cap yields further out the curve, you know, just like Australia has. So that could be one thing they could do. The second thing they could do is they could be a lot more aggressive in their language around inflation overshooting, you know, which could then start to impact expectations and thereby drive down real rates. Now, those are the tools they could have. I think it's unlikely that they will use them. I think it's only if we see a much larger correction in markets that would likely to see the Fed come into action. Because the issue for Fed and other central banks, in fact, is because they're closer to the lower bound, they need to keep their powder dry for a real emergency. And so the question is whether this will turn into that real emergency or not.
Bilal, there was a lot of conversation as to what led to the sell-off yesterday. Equities are stabilizing today, but I want to ask, is part of the reason we saw that sell-off because inflation expectations have actually started to roll over, so we had to kind of diversify back into tech, back into the dollar, because there's a disbelief that the Fed actually can't get that 2% inflation target versus the more reflationary theme we saw in the markets for the last couple weeks?
No, I think that's a very good point. And, at Macro Hive, we did this study looking at corrections in the US stocks over the past 3-4 months. And almost all of them coincide, plus or minus 4 or 5 days around a Fed event. So whenever the Fed does something, you then see a correction because the market often gets disappointed. So I think part of it is to do with the Fed not being able to, or saying itself that won't be able to generate inflation. But I think the proximate trigger for the sell-off yesterday was more to do with fears around a second wave in Europe. And then also some bank-related stories around the money laundering story that came out.
Bilal, there was some disappointment in the Fed last week when it didn't deliver upon more QE. And it didn't hint at more QE. And there was certainly an assessment in the market that the Fed is going to have to do more when it comes to quantitative easing. Do you believe that it will? Is that the next lever that it will pull, and in what size?
No, that's a good question. It really kind of comes back to what is the Fed's objective. If the objective is to raise inflation and allow it to overshoot, then it does likely need to do more, more in its actions. The trouble with QE and many of these measures is whether it goes to the right parts of the economy that is able to generate inflation. Because at the moment, the general analysis suggests that doing more QE simply just reflates asset markets and financial markets. And in effect, the rich have those assets. They don't spend as much as people without that wealth. So there's a big question mark as to whether QE really does generate inflation, no matter how big it is.
That's such a great point, because yesterday the Fed released a report that said the net worth of U.S. households increased by $7.6 trillion in the second quarter. That's after $119 trillion in the first quarter. And you can argue that that is the asset price inflation. Then you have things like savings rate is not really budging. Europeans are saving a lot more as well. How do we get the money out?
Well, I mean, I think in the end, you have to kind of work out a way of getting money to the average guy in the street. And so that would mean that the Fed would need to somehow underwrite bank lending to people on lower incomes, to people who banks aren't really willing to lend to, and to do that much more effectively. So I think that should really be the focus if the intention is to lighten credit conditions for most of the public in a country like the US.
Given the market is a discounting mechanism, if we look beyond November and think about the possibility of a Biden win and the potential to that be accompanied by a Senate sweep, what are the implications for inflation of that? What are the implications for the Fed of that? You guys have been trying to run some numbers on that. I'm just wondering what conclusions you've drawn.
Well, I think one of the interesting conclusions we've drawn is that in many ways there's not such a big difference between Trump and Biden. Both in some ways are sort of big government people. Both have tried to increase fiscal deficits. Both are quite negative on the trade war side. Where the big differences lie are kind of two areas, really. One is deregulation. So Biden will regulate more than, say, the Trump administration would. And then the other side, which perhaps is a bit more subtle, is that Biden may allow more rights for workers, which could in the end become more inflationary. So, allow more unions to be formed, raise minimum wages, and those sorts of dynamics. So that could be the one channel through which you could see inflation sort of pick up. And the other one, of course, would be if the Biden administration is able to increase government spending and infrastructure and so on, that would directly introduce money into the economy more directly than cutting taxes.
Well, that's interesting, and I should point out that we're waiting for Mnuchin and Powell to begin speaking. You're looking at the opening statements from the House Financial Services Committee as they're going to testify on the stimulus programs. Bilal, that's interesting you say that, because I wondered if that was going to start happening early in the crisis when you had all the lower wage workers get raises for coming in, and then the raises filtered out. But I wondered the role that unions could play and any sort of shift back in balance to the worker as we come out of this.
Yes, absolutely. I mean, it's certainly with the Biden administration and with such a big focus on income inequality, there has to be something around workers' rights. You've seen that already with the rights of gig workers in California, whether Uber drivers get the same rights as full-time employees or not. And interestingly, the Supreme Court's vacancy could actually have an impact on this, because the Supreme Court could end up appointing a more right-wing judge, which could start to lead to more cases which roll back regulations which impact businesses and force Congress to pass legislation rather than allow regulations to impact businesses. So there could actually be some interesting dynamics here between from the news that we've had recently from Ruth Ginsburg's passing away.
What impact do you think her passing will have on the outcome of the election? There's a number of schools of thought here. It was interesting to see how we did see a pickup in Biden funding, but it does give the president maybe an opportunity to pivot the narrative away from the virus. How is this going to be impacting the politics? And by extension, how should the market be reading it and trading it?
No, that's a good question. I mean, I think for me overall, it's a bit of a wash in terms of like who's going to gain from this, because on the one hand, as you rightly point out, this does take the attention away from COVID, which obviously negatively impacts President Trump. But on the other hand, when we do get the hearings for whoever the nominee is, that could bring the attention back to what the Supreme Court could do about the Affordable Care Act and healthcare. And also it could bring up the question of abortion and Roe versus Wade, which are highly divisive, topics, and also could start to turn away some of the younger or female votes for the Republicans in the upcoming election. Also, more recent polling seems to suggest, or surveys seem to suggest, that the Supreme Court appointments are more of a higher priority issue now for Democrats than they are for Republicans. So in terms of galvanizing the base or increasing turnover, this could end up helping support the Democrats. So I think it's really hard to sort of pick out which one of these effects is a dominant one. From what we can tell in terms of early polling and the prediction markets, they haven't really moved a huge amount on this news so far.
Yeah, that's such a good point. But does it become a single issue election? It doesn't seem like that has happened in the last few days. Well, as we wrap up here, how do you hedge against the election, and what do you hedge? Like, is it the day? Do you hedge until January 20th? What are you talking to your clients about?
Yeah, I mean, my kind of take overall is we've crunched the numbers around elections and so on, and it's really hard to discern a clear pattern around the election itself. My sense overall would be that in the run-up to the election, I would probably stay away from US stocks and instead focus on non-US stocks. And then after the election, then I would then re-enter and look to buy US stocks. Because typically, I think once the uncertainty goes and we remove any fears of a contested election, which of course could be a big issue, then you have more clarity around the path. And almost whoever wins, I think then the more interesting trades do come up. But I do think, the curve steepening trade, for example, is something that will continue. I think a weak dollar trend is something that will continue as well.
All right, Bilal, always good to catch up with you. Guy and I are going to work really hard to find a question you can't answer. That's going to be like our goal. Bilal Hafeez, Macro Hive, thanks a lot. Really good to see you. All right, still ahead, we're still waiting for U.S. Treasury Secretary Steve Mnuchin and Fed Chair Jay Powell to take some